Hello everybody, welcome to another episode of Erickson TV. Kurt is here by myself today. Lauren is a little under the weather, so I'm going to fly solo today. I wanted to kind of follow up to our last episode, which by the way, if you haven't seen it yet, go on to our Erickson TV site at curtcpa.com and look at that episode about Social Security benefits. And what I talked about was that it's projected in like 10 more years that the trust fund will only be taking in enough money for Social Security to pay about 75% of the current benefits. So what I wanted to talk about today is let's say worst case scenario that there is going to be reduced benefits. What we're finding is more and more retired clients are still going to be able to rely on Social Security benefits. And one of the things that people forget about, and I just had this conversation with a client that was looking at perhaps retiring in a year or so, one of the things that they don't realize is when you start taking Social Security benefits, depending on what other income you have, you could pay a substantial tax on those benefits. And so back in 1991, the taxation of up to 85% of Social Security benefits was introduced. And last year, all the Social Security benefits paid in 2011, over $22.2 billion was paid back in taxes on those benefits back to the IRS and the federal government. So it is a substantial tax. What I thought I would do is, in a very simple way, let you know the impact of what the tax could look like. And I'll just do it as if you were single. It would also factor in if you're married, but if you were single and you, let's say, made $23,000 in Social Security benefits, if you had just $25,000 of other sources of income, whether it's part-time wage earnings or investment income or interest and dividends or pension, you'd be paying about $1,000 back to Social Security in tax of those benefits. If you had $23,000 in benefits and you had $35,000 of income, now the tax goes up to almost $3,000. And if you had Social Security benefits of $23,000 and you had $45,000 of other income sources, you would pay almost $5,000 of those benefits back in income taxes. So what are some strategies to solve this issue? Well, perhaps make a lot of other income so they can kind of absorb that tax. The other strategy is especially if it's investment income, make sure that you're utilizing good strategies that we recommend in the type of income that is generated from your portfolio. For instance, tax efficient portfolios, capital gains versus interest income, less dividends and interest being spun off. So there's a lot of strategies in how you build your portfolio so you can reduce the other income to reduce this Social Security penalty tax. Last but not least, this is something that does require good planning for the day you retire and if you should maybe work longer and then take the benefits later. So please feel free to use myself and Lauren as a resource, and we'd be happy to go through that projection with you. So when people look at retirement in summary, they look at the Social Security benefit that you're going to receive, but you don't always think about the tax that you're going to have to pay back to the government. So thank you for watching this episode of Erickson TV, and we'll see you next time. Bye now.